Welcome to the deep dive. Today we're really digging into one of the giants, Johnson & Johnson. We're looking at their Q3 2025 results, and, well, they're calling it a new era of accelerated growth. Pretty bold stuff.
It is a bold claim, definitely, especially when you think about the headwinds they have faced, right? Our sources show this big patent loss for Stelara, their blockbuster. So our mission really is to see if this claim holds water. We need to look at the numbers, the pipeline, and this huge strategic move they announced with Orthopaedics.
Exactly. We're focused on what they actually delivered. So let's start with the top-line financials. Just get the overall picture. Worldwide operational sales grew 5.4%. That brought total sales to $24 billion for the quarter. But for me, the kicker is the profitability. Adjusted diluted EPS, earnings per share, jumped 15.7% to $2.80.
Right, and that EPS jump, that's maybe the first big clue that something fundamental is shifting. It suggests they're getting a lot more profit out of each dollar revenue than they were before. Better mix, maybe better cost control.
Okay, so let's tackle the toughest part first. Innovative Medicine, their pharma division. They pulled in $15.6 billion in sales, which is 5.3% operational growth. Now here's the crucial bit. That 5.3% growth happened even with a massive, a 1,070 basis point headwind just from Stelara's patent loss.
Yeah, think about that number for a second. 1,070 basis points. That's like a 10.7 percentage point drag on growth from just one drug. So to still grow over 5%, it means the rest of their portfolio had to effectively deliver something like 15 or 16% growth just to make up for Stelara and then add that 5% on top. That's pretty remarkable in big pharma. It speaks volumes about the depth they have now.
Okay, so let's break down that replacement engine, as you put it. It wasn't just one drug saving the day. The source material highlights, I think, 11 different brands hit double-digit growth. We're talking established names like Darzalex, Tremfya, Spravato, but also newer things like Carvyktuck really stepping up.
And it really starts with oncology. That whole segment grew almost 20% operationally in Q3. It's just a powerhouse. Multiple myeloma is their fortress. Darzalex grew 20% operationally, you said it. And it holds over half the market share across all treatment lines. It's the standard of care, basically. And it just got approved in Europe for an earlier stage, high-risk smoldering multiple myeloma, so it's still expanding its reach.
Now, this is where things get really high-tech and, frankly, pretty exciting. Carvyktuck. This is J&J's TAR-T therapy. For you listening, that involves taking a patient's own immune cells, engineering them in a lab to fight cancer, and then putting them back in.
Exactly. Very complex, very personalized, and very expensive medicine. And Carvyktuck's operational sales grew over 80% this quarter. Management's calling it the most successful CAR-T launch ever. They've treated, over 8,500 patients globally, and they're projecting peak annual sales around $5 billion.
Wow, $5 billion potential. That shows their R&D and maybe some smart acquisitions are paying off right now. But what about the next wave? We've seen companies ride high and then hit another patent cliff. Is the pipeline strong enough?
That's always the question in pharma, isn't it? And the sources point to two big future blockbusters, both also projected at $5 billion peak sales. First is Inlexa for bladder cancer. What's really neat here is the delivery system. It's like a device that releases the drug directly in the bladder over time, so localized treatment, potentially fewer side effects than systemic chemo.
Interesting. And the second big one?
That's in lung cancer. It's a combination therapy. Riviprant plus lazertinib. The data they're showing suggests it significantly reduces the risk of death compared to osimertinib, which is a current standard of care. If they can really prove that superiority in lung cancer, yeah, that $5 billion projection looks pretty solid. These two alone could fill a future Stelara-sized gap.
Okay, let's shift gears to immunology. This is the area that had to manage the Stelara transition most directly. Tremfya seems to be the star here, right? 40% operational sales growth. That's huge. I'm guessing that's not just from its original use in psoriasis.
No, definitely not. A lot of that growth is coming from new approvals, specifically in inflammatory bowel disease, IBD. J&J thinks Tremfya can become a $10 billion plus drug, a true mega blockbuster.
$10 billion. Why so high? I mean, the IBD market is crowded.
Yeah.
What makes Tremfya stand out for patients?
It seems to be about convenience, mostly. Patient experience. Tremfya is the only drug in its class, an IL-23 inhibitor, that has a fully subcutaneous regimen for both ulcerative colitis and Crohn's disease. So fully subcutaneous just means it's an injection under the skin. Patients can often do it themselves at home. Compare that to needing IV infusions at a clinic every few weeks. That simplicity is a big deal for adoption.
Right, that makes sense. Easier is often better in chronic treatment.
Yeah.
And they're not stopping there. They're already lining up the next generation drug, Ikatrekibart.
Yes, Ikatrekibart. And this could be really transformative if it works out. It's an oral peptide. It blocks the same target, the IL-23 receptor, but it's a pill. They've already submitted it to the FDA for plaque psoriasis. Imagine going from even a convenient injection to just taking a pill once a day. I mean, that would absolutely revolutionize how these chronic inflammatory conditions are managed long term.
Wow. Okay. And quickly, before we leave innovative medicine, neuroscience looks strong too.
Yeah.
Spravato for treatment-resistant depression grew 61% operationally and treated over 180,000 patients. That's significant impact.
Yeah, and that ties into their M&A strategy again. Remember Capliduta acquired through intracellular therapies? It brought in $240 million this quarter. They project it hitting $5 billion annually, too, especially if it gets FDA approval soon for adjunctive major depressive disorder.
Okay, remind us, adjunctive major depressive disorder. What does that mean for a patient?
It's really important. It means the drug is used on top of standard antidepressants when those drugs aren't working well enough on their own. This targets a huge group of patients who often feel stuck, trying different things without getting full relief. Capiliida could be a major new option for them.
Got it. Okay, let's catch our breath and pivot to MedTech. This side of J&J also had solid growth, 5.6% operational sales. It feels like this growth is coming from them really sharpening their focus, right?
Yeah.
Down to cardiovascular, surgery, and vision.
Absolutely. And the cardiovascular focus is where you see the biggest shift, growing around 12% operationally. They've spent serious money buying innovative companies here, and it looks like it's paying off fast.
Right, let's talk about a couple of those acquisitions. Shockwave, for instance.
Shockwave's a great example, growing over 20%. It's this device that uses sonic pulses, like sound waves, to break up calcium in blocked arteries. They expect it to be their $13th billion platform in medtech by year-end. It just treated its millionth patient. Shows they can buy cool tech and scale it up quickly.
And here's a point that really backs up the accelerated growth through innovation idea, not just buying sales. Abiomed makes the Impella heart pump, grew over 15%. But it's the clinical data that's stunning.
It really is remarkable data.
Yeah.
New results showed that using the Impella CP pump routinely in heart attack patients with cardiogenic shock, that's when the heart suddenly can't pump enough blood. Cut mortality by 16.3%. That's huge. But the metric that really hits home, it translates to patients living an average of 600 extra days.
600 days. That's almost 2 years of extra life, on average, for someone having a catastrophic heart event. That kind of outcome, well, that justifies focusing on high growth, high margin innovation, doesn't it?
Precisely. When you deliver that kind of value, it supports the whole strategy. You see strong growth elsewhere, too. Electrophysiology grew nearly 10%, helped by their Varipulse platform for treating heart rhythm disorders. Real-world data showed 99.7% effectiveness in procedures. That kind of reliability is key for surgeons.
Okay, moving quickly through the other areas. Surgery grew about 3.3%. Looks like biosurgery and wound closure were the bright spots there. And they're looking ahead with that Otavio robotic surgery system.
Yeah, that's one to watch. They're aiming for an FDA de novo submission in early 2026. Now, for you listening, de novo means it's truly novel technology. There's no existing category for it at the FDA. It's high risk, potentially high reward, aiming to carve out a whole new space in robotic surgery.
Gotcha. And vision. Over 6% growth, led by their Technis eye lenses used in cataract surgery, plus new contact lens launches in Europe and Korea. Okay, so all this strong performance, this focused growth, it kind of sets the stage for the really big strategic news, doesn't it?
It does. The planned separation of their orthopedics business to Pew Synthes. This is probably the clearest signal yet that J&J is serious about becoming a more focused, higher growth, higher margin company.
Let's talk rationale. Orthopedics is huge, right? A $50 billion plus market, and Dipoli is a leader. And you noted it actually returned to growth this quarter, knees up 5.6%, hips up 5.1%. So why spin off something that's big and growing? Seems a bit counterintuitive.
Well, it's only counterintuitive if you're not laser focused on accelerated growth and higher margins. Orthopedics is solid, yes, but the overall market grows a bit slower, and margins are generally lower than in, say, complex oncology drugs or cutting-edge cardiovascular devices. So separating it removes that slightly lower growth profile from the J&J average. It lets the remaining J&J focus capital and attention purely on those areas with potentially faster growth and higher returns, like SciRT, like a Biomed.
So it's strategic subtraction to enable faster addition for the remaining company.
Exactly, and they put numbers on it. They expect the separation to boost the remaining medtech business's growth rate and operating margin by at least 75 basis points each. That's a significant improvement overnight just from portfolio shaping. Makes the remaining core look leaner, meaner, more profitable.
Okay, that makes the strategy clear. And logistically, they're aiming to complete this in 18 to 24 months, trying to make it tax-free for U.S. tax purposes, which is standard. And crucially, they said no change expected to the dividend. Sounds like they want a clean break that benefits both the ongoing J&J and the new standalone ortho company.
Yeah, it seems well thought out. DePuy Synthes gets to be the biggest pure-play orthopedics company globally, free to invest solely in that market. And J&J gets to sharpen its focus on its chosen high-growth areas.
Okay, let's wrap up with the outlook. What does this confidence mean for the future? They actually raised their operational sales guidance for the full year 2025, midpoint now $93.2 billion. And even with higher taxes from this One Big Beautiful Bill Act, they kept their full-year adjusted EPS guidance firm at $10.85.
Right, holding ETS despite higher taxes reinforces that efficiency point we talked about earlier. But the real tell is their commentary on 2026. Management basically said the current Wall Street consensus growth forecast around 4.6% is too low. They're signaling pretty strongly that total growth next year will be over 5%.
That's putting a marker down, challenging expectations. And that connects to their M&A strategy, right? They actually came out and said they don't need large M&A to hit the high end of their growth targets.
And that statement, that's huge. It's a massive vote of confidence in their internal pipeline and the success of those recent smaller deals. It means they don't feel pressured to do a giant risky acquisition just to plug a gap from patent expirations. They can be selective, disciplined, fund their own R&D, and do smart bolt-on deals. Like Inlexa bought early, now potentially a $5 billion drug. That's the model.
So boiling it all down from this deep dive, J&J's new era of accelerated growth claim seems pretty well supported. They've navigated this Stelara cliff with a surprisingly powerful portfolio performance driven by innovation. And the orthopedic spinoff is the big move to sharpen focus on maybe 6 key high-growth, high-innovation areas going forward.
It really looks like a deliberate pivot, moving from being a diversified healthcare giant managing many stable markets to becoming a company relentlessly focused on transformative medical and pharma breakthroughs with higher margins.
Okay, that leads us perfectly to our final thought for you, the listener. We heard the orthopedic spinoff should happen in the next 18 to 24 months. Management says their goal is focusing capital on these core, high-growth areas, and they don't need huge M&A anymore. So the question is, with capital being strategically freed up and a proven ability to spot and grow smaller bets into blockbusters, what pivotal, high-value small acquisition might they pull off in the next 18 months to further boost one of those core areas? Something for you to think about.